Welcome, everyone. I'm Kara Griffith, the President and CEO of Tax Analysts. Thank you for joining us today. As you will hear our panelists discuss shortly, Europe produces world-class research. But unlike the United States, Europe struggles to leverage that research to create world-class technology companies. Today, we'll discuss what's behind that problem and what policymakers might do in tax policy to help address it. As I'll explain in a moment, it's not only in Europe's interest, but also in America's interest that Europe address this problem. So today's event is another installment of Tax Analyst webinar series known as Taxing Issues. We started this series to give the tax community a regular forum for open, bipartisan debate, bringing together policymakers, practitioners, and outside experts to discuss where tax policy and administration are headed. We're always looking for ways to improve these webinars, so if you have thoughts about today's format or ideas for future topics, please send them to events@taxanalyst.org. In fact, today's discussion grew out of such a suggestion and a paper published in Tax Notes. For those of you who would like CPE credit today, please be sure to participate in the program for at least 50 minutes and answer at least 3 of the poll questions that will appear throughout the webinar. They will appear on the right side of the viewing window above the comment section. To receive credit for your answers, you need to register with Pigeonhole, our interactive Q&A system, by providing your name and email. Also, please remain in the default viewing window because you will not be able to see the questions if you expand the program to full screen. The course materials, which we sent out in advance, are also available for downloading under the viewing window. So for today's event, the problem we're discussing today is often called the innovation gap or the scale-up gap between US and European tech companies. It has been a subject of widespread attention in recent years from Europe's top government officials, leading economic figures, and other influential experts. For example, in September of 2024, Mario Draghi, former Italian Prime Minister and European Central Bank President, issued a report on the future of European competitiveness for the European Commission, in which he highlighted the scale-up gap in advanced technologies. In January of this year, former German Finance Minister Jürgen Kukes and former Bank of France Governor Christian Neuer presented their recommendations on how to address the scale-up problem under a German-French initiative known as Financing Innovative Ventures in Europe, or FIVE. And then in April, Belgian Research University, KU Leuven, issued a study on how the EU's proposed 28th regime would provide a single set of rules for corporate, tax, and labor law to boost European competitiveness, how that could work alongside the separate regimes of all 27 EU states. Then last month, Scott Levine, a former U.S. Treasury Deputy Assistant Secretary for International Tax Affairs and now a partner at Baker McKenzie, drew on this work and published a 3-part paper entitled Tax Policy as a Catalyst for Innovation, Attracting Talent. We published it in Tax Notes, and we have made it available for all of you to download in our materials. Scott is with us today as part of our distinguished panel, which I will introduce in a few moments. Since Scott outlines the problem in very clear language in his paper, let me quote a few sentences from the top. Quote, Europe's technology competitiveness problem is not a research problem. European universities produce world-class science. European engineers are among the most sought after in the world. The problem is what happens after the research is done and the company is formed. The companies that European talent builds tend not to stay European. They relocate, relist, and scale on the other side of the Atlantic. This is not primarily a story about tax rates, but tax architecture is a significant part of the story, and it is at least one of the parts most immediately within the reach of legislative action. End quote. Scott goes on to propose 5 EU tax reforms, which he says the EU should be able to adopt without needing to amend any treaties. I'll attempt to summarize these relatively quickly. First, harmonized employee stock option taxation. Employees of qualifying companies could elect capital gains treatment from the grant date and defer income recognition until the sale date. And the EU would have to preempt social changes in some high contribution states that otherwise would effectively override the deferral. Second, a capital gains deferral for startup investment. Gains realized on the sale of shares in unlisted companies, qualifying companies, would be deferred when founders and investors reinvest the gains in the next generation of innovative ventures. This reform would be more conservative than the current US version, which excludes rather than merely defers any tax liability for such gains and is also available to passive shareholders. Third, a harmonized EU-wide transferable R&D credit. So a company that earns a credit it can't use because it owes no taxes would be able to sell the credit to a profitable company in any EU state, and the member state of the first company would compensate that of the second company through a treasury-to-treasury settlement. Fourth, harmonize net operating loss carryforwards for innovation companies. To protect early-stage companies from failure, EU member states would be required to let qualifying innovative companies carry their losses forward during a defined pre-commercialization period. And fifth and finally, coordinated and harmonized full expensing for businesses. Because European businesses now face a much higher after-tax investment cost than their main competitors, the EU should consider at least an 80% first-year deductibility for qualifying equipment and machinery and immediate deductibility for qualifying R&D expenses. Scott suggests that all 5 of these reforms should be compatible with Pillar 2's global minimum tax, accessible to pre-revenue startups, permanent and inflation indexed, and mandatorily harmonized across member states. As I mentioned earlier, a more competitive Europe could serve not only Europe but also US interests. It's because it could strengthen the West's competitive position against authoritarian models of state-directed innovation. So with all that said, we have a fantastic panel to discuss the issues today, assess the reform ideas that Scott has presented, and opine on whether such reform, with its inevitable challenges, is worth the effort. So let me introduce our speakers and we'll get underway. I've already introduced Scott Levine, partner at Baker McKenzie and author of the paper that we're discussing today. We're also pleased to be joined by Benjamin Angel, Director of Direct Taxation at the European Commission's Directorate General for Taxation and Customs Union, and Christian Kaiser, Executive Vice President and Global Head of Tax at Siemens AG, and also a member of the Tax Analyst Board of Directors. And we have Gerhard Humer, Director for Economic and Fiscal Policy at SME United. Thank you so much for joining us all today. We are delighted to have you. So Scott, I did my level best to summarize your paper, but I want to give you a few minutes to go more in depth on why you wrote the paper, what you hope it will accomplish, and sort of to set the stage for our conversation today.
Thanks, Karen. And before I begin, I just want to thank Tax Analysts for all the help they gave me both with the paper and by putting this program together. So I think this and programs like it will be really helpful in trying to keep the ball moving with respect to European tax return. So I want to start, though, by narrowing the conversation. In my view, Europe's innovation gap is one of those phrases that can mean almost anything to anyone. And if we let that get too broad, we risk spending the remaining time we have today talking past each other. So let me try to reframe it a little bit. I think that the gap that really matters, as you mentioned, the one that Draghi put at the center of his report and the one that the 5 report went back to, it's, as you mentioned, it has nothing to do really with European science that's very advanced. And it's not a shortage of good European founders for sure. Now, on the raw inputs, Europe is extremely competitive. World-class universities and research institutions that you mentioned, and a very vibrant early-stage startup ecosystem where the number of companies actually has quadrupled over the past decade. The problem is what happens after the research is done, after the companies form. And as you mentioned, European companies struggle through the scale-up phase, the transition from proven innovation to large-scale production and global distribution. And they tend to struggle because they can't reach domestic capital, the integrated market, or the IPO infrastructure that such a transition, the scale transition, requires. So the companies European talent builds tend to not stay European. As you mentioned, many relocate, they relist, they scale on the other side of the Atlantic. And if I may refer to an analogy I used in the paper, the problem isn't really the seed, it's the inability to water the plant. So how do we fix this watering problem? And I think to put this in perspective, that the stakes are extremely high. The productivity gap between the EU and the US is now roughly 20%. And it's almost entirely attributable to the tech sector. the strategic dimension is just as stark. There are 3 non-EU tech companies that account for about 70% of the European cloud market, while the largest European provider, I should say, holds less than 2%. So Europe isn't just lagging in producing technology companies, it's becoming structurally dependent on foreign providers in really one of the most critical digital infrastructures that we will have in this century. And so where does tax fit into all of this? And here I do want to be careful because it would be easy, very easy for a tax policy wonk like those on the call. I'm sorry, on today's chat, to walk into a room and tell you that tax is the answer. It's a cure-all, it's a panacea. In my opinion, it isn't. Tax is not the binding constraint here. The binding constraint is the current state of the EU's capital markets. They're fragmented, they're shallow, with 27 national systems where one deep pool is really needed. So when I talk to European-based PE funds and investment bankers, they tell me that if they could wave a magic wand and fix just one thing, it wouldn't be the tax code, it would be the Savings and Investments Union actually getting built so that Europe's enormous household savings stopped sitting in deposits and really started investing, funding growth equity. So why did I write the paper about tax? Aside from the fact that I really wouldn't hold myself out as a capital markets expert. Because I believe that tax is like probably the cheapest and fastest moving complement to the capital markets agenda. And Europe has spent most of the last decade focused on other agenda items. The decade of international tax reform was at its core, and I will admit being part of this, it was defensive. It was about building a floor, stopping profit shifting, ending the race to the bottom, protecting the base. And I'm not suggesting that those concerns were not important or shouldn't have been addressed, but it was fundamentally about dividing the pie more fairly. And then, in my opinion, while Europe perfected its defenses, it let the growth side of the ledger atrophy. The offensive playbook, how do we use the tax system to pull risk capital and talent toward European innovation, received very little attention. That's the gap in the policy conversation that the paper is trying to fill. 2 ideas I'd ask you to, and the rest of our panelists, to hold on to as we go forward, because they're guardrails that I think are necessary, and that discipline everything else we'll talk about. Very quickly, first is that Europe should adapt, not copy. I do lean in the paper on American templates in this, and this qualified small business stock rules, the transferability architecture of the US green credits. And I want to be upfront about that, but I'm borrowing the mechanism, not the precise tax benefit. In my opinion, the US version of QSBS has some flaws, and the green credits transferability mechanism needs to be reworked to address unique issues that would be raised with respect to R&D credits. A European version has to learn from those mistakes, not import them. And the second thing I'd ask us to think about is that the design for constraints we actually have, not for the ones we wish we had. And so 2 constraints in particular, one is Pillar 2. Any incentive Europe builds now has to survive the global minimum tax, or Globe will quietly claw it back and we've accomplished very little. And the good news is that the OECD side-by-side package in January actually made room for genuine substance-based incentives. So this is now a solvable design problem, not only if you design it the way you've always designed it, but to be more focused on substance-based incentives, and that those design restrictions should be implemented on day one. And the other constraint is simplicity. If an incentive is so complicated that a 2 or 3 person founding team, for example, can't claim it without hiring a firm like Baker McKenzie, then it isn't really an innovative incentive. It's probably, I dare to say, a subsidy to tax advisors. So I'd rather that those don't get built, and simplicity should dominate to the extent possible. And Lastly, I just want to say there's a reason the window is open right now, which I suspect we'll get into a little bit through this conversation. And that is that the disruption to research funding and the talent pipeline on the US side is dislodging exactly the people and capital Europe has spent years trying to attract. That's a multi-year recruiting opportunity, but only if Europe has something concrete to offer when those decisions get made. I've experienced this with friends in the VC area that are scientists at NIH and are rethinking where they might call home. So that's how I'd like to frame the hour. Tax is not the hero of this story, but it's a lever that's been sitting unused on the table while everyone worked on the harder, slower machinery next to it. And leaving it there is a choice Europe can't really afford to make anymore. So I'm looking forward to this discussion, and I say let's get going.
Fantastic. Thanks so much. I do believe, though, that tax is the hero of every story, and hence we have tax notes. In any case, thank you very much. Appreciate the setting of the stage there. Benjamin, I'd like to turn to you. First, thank you so much for joining us today. We genuinely appreciate your time. Wanted to give you an opportunity to give your thoughts on Scott's paper and sort of the topic more generally.
Okay. Well, first, Scott deserves to be congratulated. It's a very serious and extensive paper and a very interesting one, bringing a lot of material, and he put a lot of thinking into it, also seeking many opinion around. I fully agree with the introduction from Scott that the main problem we have is not of tax nature. The main problem is clearly the inability of the European Union to have deepened and integrated capital market. This comes primarily from a number of elements where we compare poorly with the United States. Our pension funds are very small. They represent around 25% of GDP, while in the US it's around 150. This has an impact on our ability to have patient investors to finance startup, but also an impact on our ability to finance Series Cs, to have big tickets of above 100 million, where we have very few investors with this capacity in Europe. The second big problem we have is the lack of appetite for ordinary people to invest in equity products. That's a big difference with the United States. We have more than 10 trillion euro slipping literally in deposit account in the European Union, and therefore not contributing to the financing of the economy. We have, as Scott mentioned, an avalanche of trading venues. Actually, we have more than 300 different ones. And when you have so many, it means they're all relatively small with a relatively expensive cost when you're using it. And we have too many blockage put on securitization. Does it mean that tax has no role? No, otherwise we would not be here today discussing it. Scott has mentioned a number of elements. He mentioned loss carry forward, and that is clearly something that is helpful and already existing in a large number of member states. He mentioned full expensing. Full expensing is implemented in some member state, but it's really a minority. We have recently proposed in June to have a full expensing for tangible assets of R&D at European Union level. He has mentioned capital gain deferral, and that is an interesting idea. We're looking into it actually for forthcoming initiative on business angel. We don't have a rich business angel community in the European Union, and like the United States, it's not so much part of our culture, but clearly it would make perfect sense. And then you have the more difficult question that he brings of transferable tax credit. It's a bit foreign to the EU culture, to the EU tax culture at least. And Scott put the bar even higher, because not only does he want a system of transferable tax credit, but he wants a transferable tax credit at EU level, which add an extra layer of ambition. It doesn't exist today, would bring plenty of issues that we can discuss also during this panel. But all those ideas are interesting, they're useful, they've been tested in the United States and in some other jurisdiction, and can help making progress in the right direction alongside the big picture, because the big picture is clearly building a true well-functioning savings and investment union with an integrated capital market. Otherwise, companies will keep on crossing the Atlantic when they need to grow.
Excellent, thank you. Christian, and then Gerhard, I'm going to turn to you as well. I would also like to give you an opportunity to comment on Scott's paper more generally, and what Scott and Benjamin have now said. I'm also interested, Christian, in your thoughts on whether framing this. We've heard both Scott and Benjamin now say that this really isn't a tax problem. So I'm interested in hearing whether you think that that framing Europe's innovation challenge as a tax architecture issue overstates what tax policy can do. Are we trying to pigeonhole tax policy to fix a problem that maybe tax policy can't?
Well, you know what? I'm working in a big company, and I'm used to, if there's a problem, that people look at tax, and if they can't explain it, then usually it must be a tax issue or a legal topic. I would agree in this case of EU's innovation gap, tax alone can't fix it. But I would also agree with Scott's analysis that there are a couple of low-hanging fruits which you could pick up and work towards closing this innovation gap. Because the problem for me, if you look at the situation, and the Draghi report was mentioned, is that Europe would have to go all in. If we want to close this gap, we need to go all in, and this embraces this includes tax and the necessary steps to really become competitive here. But not only tax, right? The funding gap was mentioned, and the differences in access to capital. But there's much more than the funding gap. I mean, talent, yeah, there's an opportunity to tap into talent pools in the US right now, apparently. But what I see in reality is this opportunity didn't fully materialize, because when we hire people, they don't want to come over. They don't want to come over for whatsoever reasons, right? I mean, you will always find individual topics, but so far, I haven't seen one of the very expensive tech talents, but they all want to stay where they're used to do their work so far. Then we have the data regulation. Europe is very focused on the protection of certain human rights. I don't want to call it human rights, but civil rights. So the Data Act, the AI Act, they are all very much focused on data privacy, on security. And there is a value to this. I'm not denying that there's a value. But if you are a startup, if you are in the tech area, then actually you don't want to be bound by regulations. You want to experiment. You want to have access to data. You don't want to adhere and live up to all those rules. So the regulatory environment is simply such that you are much freer if you operate across the Atlantic. At least that's the perception. If you look at all this in conjunction, then I think this is the combined reason why people are moving over and seeking their better future with their startups in an US environment. And where I'm actually not extremely optimistic is the fact that in Europe, and I'm mostly speaking for Germany, which is in the center of Europe, we have been relying on three parameters and thought that they are a given forever. And this is US defense. I wouldn't say it's totally gone, but well, we have to spend more on our defense now because it's not anymore guaranteed as it used to be. Cheap energy from Russia. Don't have to explain where this went to. And then the Chinese market. which especially for the very export-oriented German industry, but also for the car manufacturers, not only from Germany, but from France and Italy and Spain, was a key market. And all three have materially changed. So the good weather condition that we were used to is gone. And that is where I believe we need a concerted action, which includes tax, but a concerted action encompassing all policy areas.
Excellent. Thank you. I have questions I want to come back to on that. But Gerhard, before we do that, I would love to get your take on what has been said so far. Also, your group works with startups and scale-ups. I'm very interested in what your thoughts are on what the problem is and how we might solve it, or at least how we might frame it.
No, let me start about the framing, and thanks for inviting me. I think I fully agree that scale up is the real problem in Europe and not startups and research. But there's one point which was not mentioned that much so far, which is an additional, from my point of view, even the starting point of the problem. When I speak with startup companies, they tell me it's true we have difficulties to get access to finance in Europe. But the real problem in Europe is that scaling up in Europe is so much more expensive and takes so much more time than in the US due to the non-function of the single market, due to long and complicated permitting procedures, that scaling up in Europe is not profitable enough. And if you invest in a non-profitable scale-up project, of course, you will also have difficulties to get finance. And the financing is not that big problem when we hear that 300 billion of savings every year are invested from Europe in the US. So this money is there, but it is not attracted enough in Europe. And of course, then tax reforms can do something to reduce this gap, to make it more attractive to stay in Europe. But the crucial element from my point of view is this problem with the slow scale-up performance in Europe due to the 27 different regimes we have in many areas, not only in taxation, which creates the problem. And the second element, a more general political topic I want to mention is that compared to the US, what we have seen over the last years, especially during crisis periods, Europe spends a lot of money to protect existing structures, to protect existing companies, to protect existing jobs, while in the US, including the Inflation Reduction Act, the US is focusing much more than Europe on creating new stuff, new projects, new technologies, etc., etc. And this is the second point which holds back our productivity. And I know that the European Commission worked very hard to make progress in the tax area to also other areas. But now Benjamin is there on the tax area. But the situation that you have to agree between 27 countries, unanimity on any change in the tax environment also does not help in this situation. And there's also the discussion about the coalition of the willing and the enhanced cooperation, etc. It can be a step in the right direction, but there is also a shortcoming, because if you have a core Europe cooperating, you will still have the small countries which benefiting a lot from tax engineering and tax avoidance at the moment. They even may be in a even more profitable situation if you have a huge block with harmonized taxation, and then you have few small ones who are benefiting from tax engineering. That's a little bit so my take. The 5 proposals in the paper from Scott, I like them a lot, especially the harmonization on the R&D credit and the transferability, because currently you have to be aware startups are not benefiting from R&D tax credits. They are beneficial to large companies, to the incumbents, but as long as you as a startup and an innovative SME, you are not making profits, you're not benefiting from tax credits. That's my first take.
Yeah, that all makes good sense. And it is very challenging to have a fragmented system, right? So you've got 27 different tax regimes. In the US, it's how we're trying to work with 50 different states and make them all play nicely, and this is on a much larger scale. Um, Benjamin, I'm interested in your thoughts on the so-called the coalition of the willing. I will say, having started my background in state and local taxation in the U.S., uniformity on anything is an extremely challenging exercise. In your opinion, is a coalition of the willing achievable today? Is the legislative background, is it right? Is now the time where we could achieve something like that?
It's a very difficult question, actually. The only attempt that we had so far of going for an enhanced cooperation, which is the more correct name of Coalition of the Willing in the treaty in the tax field, failed. It was for creating a financial transaction tax. The conditions set in the treaty for having an enhanced cooperation are quite substantial. You need at least 9 member states. Those member states needs to make the request to the Commission. The Commission may make a proposal to the Council that will adopt by qualified majority the right somehow for those 9 member states to start an enhanced cooperation. In practice, we have very few successful enhanced cooperation at EU level. I'm not even talking of taxation here. We have one, for instance, on divorce. We have one on patents, and we have the European Public Prosecutor Office, which is also an enhanced cooperation. But de facto, it's quite difficult to use. It's not impossible when there is a will, where there is a way, but there is scarcely a will to build something in common outside of the standard European Union format, which brings us back to the difficulties that Gerhard was mentioning. In the tax field, that is the only policy, if we put aside foreign affairs, where unanimity is still requested. It doesn't mean that nothing is possible. In the field of direct taxation, we have, for instance, 17 directive, but the energy it takes to get anywhere is completely out of proportion. That's very clear.
Yeah, without a doubt, it is enhanced cooperation. However you want to phrase it, is incredibly difficult worldwide. Scott, I'd like to get your thoughts, though, kind of on the same topic. Do you see a path forward for enhanced cooperation today in Europe?
Yeah, let me just first answer or comment on Benjamin's statement, and he's of course absolutely right, and live this day every day, which is the difficulty assigned to unanimity, and also the difficulties with an enhanced cooperation effort, and the immediate failure of the FTT and what that ultimately led to. But there were, and Benjamin mentioned, there were also some successes. And I think what I'd want to say on this, just on this initial part, is that my reading is a little sharper than enhanced cooperation doesn't work. And I want to just kind of state it somewhat plainly, if I can, that the FTT's participating states agreed to cooperate really before they had resolved what they were cooperating. And enhanced cooperation can't be a substitute for substantive consensus of the policy itself. But I feel like the innovation tax context is significantly different. And the 28th regime and a European, say, some sort of qualified small business stock analog are they're conceptually well defined with clear precedents, detailed design guidance that we saw from the Draghi and the Five Courts, and a natural coalition with substantive alignment. And I think the specific thing the FTT lacked that is the thing this movement has, and that is the FTT collapsed substantially because France and Germany couldn't agree after having agreed to cooperate. And the Five Report was just starting out as a joint Franco-German product. And maybe that removes some of that risk, at least a little bit. But I think if we're going to talk about who needs to participate in in what you called the coalition of the willing, I think it's pretty important that there be at least the major economies participating. And in particular, this is I did a little quick back of the envelope. I think the World Bank put out a statistics a couple of months ago. As of now, Germany has approximately 24%, represents 24% of the EU economy. France is 16, Italy is 12. That's three countries that represent more than half of the total EU's economic activity. So enhanced cooperation under Article 20 which only needs 9 member states. This is because this is a market concept. It needs to be, the market has to be big, and the market would lack that heft if the 3 largest jurisdictions didn't participate.
So I'm going to turn to Christian and then Gerhard on this. What happens when a major economy like Germany, for example, doesn't participate? And how likely do you think that would be, that if there were an effort towards enhanced cooperation along these lines, that a major economy, let's say Germany or France, wouldn't participate?
When Benjamin mentioned the example where enhanced cooperation worked out, and actually there some more like for the Ukraine support loan just 2 years ago, there was also enhanced cooperation. But it's a handful, right? It doesn't change what Benjamin displayed. And I would call it a success that the enhanced cooperation failed for the financial transaction tax. And this is the fundamental difference here, because the FTT was just a bad idea. What we are discussing here is using enhanced cooperation for a good idea. So that might make a difference. But that's already the end of my optimism, because the problem is there's the technical threshold to get over it. If you read Article 20 of the Treaty on the European Union, you have to be out of the exclusive competencies. You have to have a reasonable period of time. So it's actually nothing really, really fast, right? You have to have at least some period of time, whatever reasonable is. And it's a last resort. And you have the 9 countries to agree on it. And actually, if it's nothing against Malta and some smaller ones, but you would have to have the big shots, the France, the Germanys, you have to have them participating. And that is where I'm not very optimistic, because politically, the governments in the major economies in Europe, I don't think that they have realized the situation we're in. I honestly believe that they are so paralyzed by the magnitude of issues that they have to resolve, by their parties losing support in the population for whatsoever reasons, that they will not move on this. And they will especially not move on something which is corporate tax and which is venture capital and startups, because there is still a very ideology-driven policy which dominates many of the European economies, where this is not making good press. And there is no politician that I can see, there are always exceptions, right? I'm generalizing here, who is actually taking a step back, looking at the overall situation, and willing to take a step which is not popular, which can't be sold good to what they perceive is what the voters want and support, because it might be on the longer run the right step. I can't see this. And this is why I believe politically enhanced cooperation is not going to fly for this one. We would have to have a major impact which triggers all those economies, and we haven't seen that yet.
It's a point well taken. It's something that we see here in the US as well, that it is very difficult to get reforms of this nature. It's very difficult to get public support for reforms of this nature. Gerhard, I'm interested, can reforms like what Scott is suggesting be achieved without enhanced cooperation? Is there some level in between where you're making baby steps in a right direction? But let's say, for example, that Christian is correct, that we won't have broad enhanced cooperation. What then?
Unfortunately, I will not be able to bring more optimism to this discussion than Christian. I would go even a step forward, because if we see at the moment the discussion not only on the tax issue where we need unanimity, but also on the very limited progress we have in other single market issues where even the head of states together say we have to make progress, but when it comes to the nitty-gritties, everyone is in favor to have a better single market, but it should mean that the own companies can sell to the outside world in the European Union, but coming in as a competitor is not so much liked. And even in the single market, it's really very, very difficult to make progress. And in taxation, it's much less common. What I see as a chance to improve the situation on innovation and financing or creation is that some of the proposals made by Scott are implemented at national level and create dynamics at national level, which maybe motivate the others to go in a similar direction. So the competition between the systems in the European Union. And the last point I would like to make is, and this is even in my organization the case, if you ask them, should we have a harmonized solution, you get very likely a positive answer. But if you bring a concrete proposal on the table, how do you want to harmonize, then everyone want to have his current solution and blocks everything which moves in a different direction, as you have seen recently by the cooperation of the new fighter airplane between France and Germany.
It's such an interesting and challenging problem. Benjamin, if you had, the proverbial magic wand, we've acknowledged that tax reform isn't going to do everything. We've talked on capital markets, we've talked pension reform, we've talked listing venues and things like that. If there were one reform track that you could go down, that maybe tax architecture has an impact on, maybe not, what would it be? Where do you think you can find, or Europe could find at least a step in the right direction, if not a quick fix?
Well, in terms of volume, the biggest effect would probably be if we were able to convince the ordinary citizens to put their money in equity rather than deposits, because here we're talking of 10 trillion euro. That would be a significant game changer in our ability to finance the economy and to finance large projects, and we would have larger funds. The Commission has made some recommendation for a savings investment account. And there are some tax elements in savings investment accounts so as to make it a little bit more sexy for the investors. But it's difficult because sometimes you have deep-rooted cultural element where people are just reluctant to invest in equity because they see it's more or less in Europe in a very similar way as playing the casino. So as something which is very risky and almost unadvisable for the ordinary good father in a family. And as long as we don't have this cultural shift that brings citizens to invest more actively in the financing of the economy, it would be very difficult. One extra consideration, Cara, if I may, just to react a bit to the discussion that has taken place so far. I think we should refrain also for thinking in two binary terms. It's not EU actions or enhanced cooperation and nothing else. You have a lot of shades of gray, and sometimes we can try to use soft law to push member states to take domestic measures going in the right direction. We have done it, for instance, for the Clean Industrial Deal, where we came out with a number of concrete recommendations for full or accelerated expensing, and built it in such a way that it was state aid compatible so as to make it easy to implement for member state. So there are possibilities sometimes to push via soft tools member state in the right direction. Admittedly, not the full union, but it's not everyone or no one. De facto, for all the measures we have discussed, almost all of them are already implemented in some of the member states. The problem is bringing the others.
And that's a very good point. And it is almost never an all or nothing, never an all or nothing deal. Scott, I'm going to turn back to you. You know, you made 5 proposals in your paper. Would you rank them? Are there ones that are more important than the others? I'm interested in your thoughts as you were writing and what you thought and what you saw.
Ooh, interesting question. So I think it depends on which incentive or which proposal, how we're thinking about them. So, for example, I think perhaps the suggestion that there be a consistent treatment of equity compensation across Europe might be easier to get consensus on than, say, a fairly complicated, admittedly complicated R&D transferable credit, especially if it goes cross-border within Europe, as opposed to each country has their own shell or pool, if you will. But I do think, and the reason I spent the most time on it in the article, I do think that the transferable R&D credit is the biggest bang for the buck. The reason I was focused on it being transferable, not just within a jurisdiction, within a member state, but throughout the entire European Union, or at least throughout the coalition of the willing, if we go that route, is that no one market's big enough really to absorb the full credit capacity that would need to be there in order to really make it fluid. So if you think about a country like the Netherlands, for example, which has one of the strongest tech sectors proportionally and maybe empirically, vis-a-vis the rest of the EU, the market itself is relatively small. And if say the 3 or 4 very large tech companies in the Netherlands would be the only ones to potentially absorb the credits from the local startups, there might not be enough to go around. Whereas if you include everybody or a majority of the members participating, you end up with a much deeper pool. And the US dealt with something similar many years ago in the 80s in the bank space, when they realized that they were consistently having liquidity issues, and they created this much larger pool where the banks themselves would be contributing and taking depending on their positions. And so it dawned on me that this could be something that would be feasible. I did run it through the fairly complex EU treaty issues, but it does seem like it could also work. There would need to be a tweak to the administrative guidance with respect to Pillar 2, but I don't think that tweak is really a problem. And I think what the proposal is consistent with the spirit of the existing administrative guidance on transferable credit. So I do think that one in and of itself, if you look at just how much money is being spent in the United States on R&D in the tech sector alone, it's exponentially greater than what's taking place in Europe. And the only way to combat that, or not combat it, but the only way to compete with that is to have in my view, a similar provision.
Gerhard, I'm interested in your thoughts on the R&D credit as well. Oh, you're muted.
Yes, now I'm back. No, but I think, as I said before already, R&D tax credits may work when this is transferable and you can sell it. But in principle, for startup companies, if you are not able to transfer it, and if you are not able to do really extensive forwarding of carry-on losses, it doesn't help startups. What we see at the R&D credits in countries like in Germany or in Austria, they are very, very beneficial for very large incumbents industries, but not very favorable for startups and SMEs, or only for normal SMEs which do an innovation project, because they are not making profits the first couple of years. And then tax credits are not really, really helpful. And therefore, the proposal from Scott are interesting. And for SMEs, maybe even in larger countries at least, even then, if it's only at national level transferable, is already better than you have neither carry-on losses and transferable credits.
Excellent. Christian, you talked very early on about talent, and I wanted to pose a question on that before we got towards the end. Are there proposals that could be implemented in the near term that would have an impact on talent, and how to attract talent, how to capitalize on displaced talent in the U.S.? What are your thoughts on that?
All right. So I mean that's also a bundle of topics, and some of them are outside of tax. First of all, work visa, immigration law would have to be fast, flexible, agile. So it doesn't help if you, and that's not a European Union topic, by the way, that's a member state topic. So where you have to be really fast in onboarding those folks. I mean, they're young there. They are used to an agile environment. They don't want to wait 6 months to a year for the procedures to come to an end, to a hopefully successful end. So that is very important. The personal income tax brackets are all across Europe pretty bad, particularly in France and in Germany. What you pay over here is it's quite significant. That's certainly not extremely attractive. And if you look at the salary packages, in Europe, people would say, cool, they can afford to pay 50% of what they earn. But actually, if you have a choice, why would you? Why wouldn't you stay somewhere where you're better off? And I know California is not the best example, right? It's not the best example, and it's also moving in a European direction in that regard. So still, I believe what you could offer them is faster immigration procedures. What you will not be able to offer for the time being is the environment, because we don't have it yet. That's part of the gap. So if you are convinced that in the valley, that is where the magic is happening, that is where all your peers are, then you want to stay in the valley, you want to be close to this magic. So the real topic is how can you bring that magic over? And that is where you need much more than only the talent focus. The talent will focus, will follow the business opportunity, the growth opportunities.
Yeah, that makes 100% sense. And Christian, I'm going to backtrack to you for just a second, because I actually wanted to get your thoughts on the idea of the R&D credit as well. Does that impact I assume that impacts large companies like your own?
Oh, the R&D tax credit is very important for us, and actually there are some examples where you can elect whether you want to have the credit or you want to have it paid out. In Austria, looking to Gerhard, offers this opportunity, and that's also then very helpful if you are a startup company. Startup company doesn't need to lower its tax expense because it has no tax expense, because it has no taxable income. So to get a refund of that value, that's really attractive. For my company, well, it can be attractive depending on the country, but we can handle the R&D tax credit, and it is, for us, it is not, I would say, it's not a location, the number one location decision parameter if you're looking for R&D, but it's one of the parameters we are looking at. In terms of the proposal, if you have a transferable R&D credit, the startup companies themselves that would be able to sell it then, for them it's not a global minimum tax problem. But for the buyer, it might create one, right? Because I'm not sure about that, but I would wonder if this credit that you acquire is covered by the side-by-side extensions of qualified substance-based incentives, because it's actually not your substance you are acquiring from somebody else. So that might lower the attractivity of those transferable R&D credits. But then again, I'm not the biggest fan of the global minimum tax in its total design. looking if Benjamin is smiling, but he knows my position on this one. And maybe this will also improve slightly over the next couple of years.
Thank you. Benjamin, I want to turn to you. We have a limited amount of time left, and we've addressed a lot of issues here, but some of them are very fundamental in that we have to get a conversation started. So if you can't get the public engaged on issues like this, and if we can't have the conversation, we will be unlikely to move this forward. So I'm curious from your perspective as to how we do that. We've spent so much time in the last 10 years talking about the so-called race to the bottom, and how are we going to avoid that, and pushing forward with BEPS and pushing forward with the pillars. How do you now have a different conversation and kind of shift things into something like this? Is that feasible? And how would you think that we're going to get started on it?
Well, it's not a 100% shift in the sense that member states are still attached to fighting tax evasion and aggressive tax practices. But let's say that for new initiatives, there is a growing awareness that the priority should be ensuring the competitiveness of our businesses. And this is also the top priorities that we have followed for the recent legislative package that we have tabled, amending 16 of our 17 directive. It's a difficult moment to have this conversation, unfortunately, because member states are, for most of them, not all of them, but most of them, in a tight fiscal situation. So if you talk to the finance ministry, there is very little appetite to do anything that may have an impact on the revenue. So we need the level above the finance ministry, the head of state and government, the one which have repeatedly said that we need to implement the Draghi report, the Letta report, the Noyer cookies report, etc., that you mentioned in your introduction, Cara, to stay focused on the big picture and accept that sometimes it's useful to have a small cost on the way if it allows to reap a bigger benefit, because the economy as a whole is growing at a faster pace. Will we manage? Honestly, I don't know. Clearly, we can see resistance to the effort to modernize our tax system and to make it more business friendly. If we were in a booming economy where all member states, with all member states thriving, probably we would face less resistance, but that's the current situation. I know that Scott reads it the other way, which is it's precisely because you are in a difficult situation that now is the right moment to act. I agree. Now is the right moment to act. We need member states to walk the talk, because we're running short of Italian prime minister or former Italian prime minister to which to entrust very good reports and to ring the alarm bell.
Scott, I want to give it was your paper that really kicked off this conversation. So I'd like to give you the last couple minutes to comment also on what Benjamin just said, and to offer any other thoughts you had.
Well, thanks, Kara. I'm hearing what I'm hearing. I know there's going to be a lot of naysayers out there. This is too hard. It's too difficult. We can't do it. I really do believe that the EU doesn't have a choice, and I think that if they continue down the path they're going, it's not sustainable. And I think first and foremost important to the EU and its citizens is that they shouldn't have to sacrifice their way of life and their approach to social welfare. And I completely agree with that. And this paper was designed to create a blueprint, potentially in the spirit of the Draghi report and the FIVE report, to on the tax side to get moving. A few things I'd mention. There are really two sovereignties that we're talking about at the same time with respect to each member state that's kind of pulling them in opposite directions. There's the digital sovereignty anxiety that's increasingly strong enough to overcome what I call the fiscal sovereignty reflex. Member states have been guarding their fiscal sovereignty very jealously, as does the United States, as Benjamin knows very well. And it's why tax needs unanimity and why Hungary and Slovakia, for example, can block directives. But the dependence has become, I think, fairly acute, as I just mentioned, to change the calculus. And there are three, as I mentioned, there's very there's from a digital perspective in particular, there's not a real dominant tech champion in Europe to compete with the largest US tech companies. And that's not a lagging really. That's a structural dependency issue. And so if you think about the paper and the reconciliation isn't to water down harmonization. The paper, I'm pretty clear, I think, that mandatory harmonization within a coalition, exhaustively defined at the EU level would be my preference, is what makes the architecture legally durable. So you have enough power given to the European Commission, and it's defined well enough that they don't need to go back consistently to ask for changes to be made and get the same votes to happen, year after year when political winds change. And I think the reconciliation is really the choice between the choice to participate and what you get for participating in the regime, and the regime being this consensus, whether it's all 27 states, whether it's a coalition of the willing. The regime that would be insulated from state aid and national and charter constitutional challenges, I think should be a big magnet or a big pull. And they wouldn't be surrendering your fiscal sovereignty. It's really just exercising it once at the door to enter this and enable the service of digital sovereignty objective would just continue to increase. I think the efforts to the magnet or the pull of the member states that have not yet signed on will become so strong that they'll see that they're better off joining than not joining. And I think if they don't reconcile these two sovereignties and they let the digital sovereignty mode supply the political energy that fiscal sovereignty instinctively wants to block, it'll get blocked, and the problem will continue. So in sum, I guess I'd say that I don't think they have a choice. Europe doesn't have a choice, and I'm hoping that they go forward and take this seriously and continue the efforts that Benjamin has started, at least with the most recent budget, and go from there.
Excellent. Well, we are out of time for today. I learned a lot. I hope we here can continue this conversation. It's a very interesting one and definitely a very impactful one. So thank you all for joining us today, and we look forward to the next one.